To start. Welcome everyone to webinar. EVORA is a webinar on SFDR 2.0, Pragmatism or Progress. My name is Paul Sutcliffe. I am one of the founders at EVORA, and I lead the consulting function across the business, and have been involved in supporting our clients to meet SFDR compliance over the last 5 years. I'm joined by Aoife Busher, and in a short while we're going to be providing a bit of information and then discussing the challenges with SFDR 2.0. There is the opportunity for you to ask questions. So please use the Q&A function on Zoom to ask those questions, and we'll do our best to answer them either during this webinar or offline if necessary. What I would say is we cannot answer questions specifically about individual funds, so please don't name funds in those questions because we won't be able to read them out. We can of course talk to you individually as and when required. So without further ado, I'd like to introduce Aoife and pass on to Aoife Busher, who is Director of Sustainable Finance, and will introduce herself and provide a bit of background on SFDR. So Aoife, over to you.
Thanks, Paul. Welcome, everyone. So I'm Aoife Busher. I have, as Paul mentioned, I've worked with Paul for the last 5.5 years on SFDR. Paul, I even checked our first webinar on the topic was June 2020. So it's been a lot of work over the last 5.5 years on the original SFDR. And in that time, I've helped dozens of clients and funds position funds. I've worked with managers in the UK, Europe, and the US, and all across equity, debt, funds for both real estate and infrastructure. So seen a lot in that period of time, and hoping to bring that experience to the new SFDR 2.0. And through that work, I've helped clients land key investors through their positioning. I've helped some clients fix some interesting mistakes that they may have made along the way, and really have been working closely with a lot of clients over the past couple of years on the disclosure and ongoing reporting elements of SFDR. So really excited today to talk about 2.0, and what we're going to do is just start off very quickly with a brief slide on what I think of as maybe is the kind of top 5 things that you might have heard about 2.0 before we dive into a bit more of a conversational piece, going through the details and some of the nuances, challenges and opportunities for real assets. So to kick us off, probably one of the things everyone has heard about in 2.0 is definitely the formalization of categories. So you may have heard of the 3 groups and 3 categories that have been released under the new regulation. So it's the transition category, ESG basics, and the sustainable category. I think one thing that's going to be really interesting for real asset managers is the fact that you can combine categories under 2.0. So a really interesting opportunity potentially for managers out there to think about. We're going to go into all of this stuff in a lot more detail in our conversation. So I'm just going to briefly run through these top 5 points. Next thing I think that will be very much of interest is that there is a specific designation for impact investing. And again, really good opportunity for managers who perhaps have more of a social element or already have impact investing frameworks that they want to bring it together under the new regulation. So we have that impact add-on, as it's called. We also have some updates on the PAI, or Principal Adverse Impacts. There's questions, are they in, are they out? Yes and no. So at the entity level, so that's the large corporates who have to do an annual disclosure on their website, that is going to be no longer required. But at the fund level, the PAI are staying in place, and we'll talk about how they will feature in the new regulation. So maybe some changes in and impacts along data collection and requests for information as a result of the entities no longer reporting. But again, we'll speak about that in more detail later. We have news as well, maybe a bit of confusion on exemptions that we just want to clear up. So in the formal draft of the regulation that was published just before the new year, we have an exemption that applies only to existing closed-end funds. So there was in a leaked draft in early November an exemption for alternative investment fund managers who are marketing their products directly to professional investors. That exemption did not carry through to the final proposal that was released. So it basically disappeared from the leaked version to the final version. And the view is that it is not expected to come back, as it was seen as maybe a bit contrary to the overall ambition of 2.0, which is to add some more consistency and keep moving in that direction. So having that carve out, I think, really challenged that message. So that's just to clear up that view on the exemptions, because it was very relevant for the group on the call today. And finally, just a status update. We're not final on 2.0. We have a lot of information to digest, but we're not there yet in terms of the kind of regulatory landscape around it. There are negotiations and a phase into an adoption phase. So not final, but a lot and enough information to get started. So those are my top 5 things that are worth noting at the start of the conversation, and probably the most common things that everyone would have heard in, LinkedIn posts and kind of rundown write-ups on the 2.0 as it was released. Before we jump into our conversation, we wanted to get a sense of the group we have today and just understand where we are with the original SFDR. So we're just going to have a quick poll to see how people have applied the first regulation. So I'm going to launch a fun question on Article 8 and Article 9 from the original SFDR. So it'd be great for anyone to participate. And as I said, give us a sense of who's in the room today. And perhaps we can tailor our conversation around this. So I'm just going to give the poll a couple of minutes to run through, allow everyone to respond. %50 have answered now, so we're getting there. Leave it another couple of seconds.
I think it's fairly stable, Aoife. So I think we can conclude that some of you have a small proportion of Article 8 or 9 funds, but there's an equal measure or a higher measure of organisations that have around half, and some, 27%, a quarter, have most or all of your funds are Article 8 or 9. So that's really helpful. So let me share the results so people can see. There we go. That's the results that have just come through. Okay. So Aoife, if we explore the topic in a bit more detail, I'm going to ask a few questions and then we'll just have a discussion on this. But first off, why has the EU decided to introduce SFDR 2.0? We took as an industry a while. As you said, you and I have been working on it for 5 years. We felt fairly stable on it. Why change now?
Yeah, that is the big question. Why now? And I think I would agree. There has been a nice sense of stability with the regulation. So it is a bit of change. Maybe not at the best time, but hopefully for the best intentions, let's say. And it shouldn't be any surprise that we have 2.0. So it's been long signposted, I guess. We had 2 consultations launched in 2023 on the original SFDR, so one in April and one in September, and they received extensive feedback on the misfirings of the original regulation. So there was a lot of information, a lot of feedback given in those 2 consultations, and ultimately the decision was made to bring in 2.0 to really try and fix those shortcomings of the original SFDR framework, particularly focused around, interpretations and inconsistencies, greenwashing risks, and a bit of weak comparability and misunderstanding, I think, of the original regulation and how it was actually used within the market. And what the EU wanted to do is come in, maybe clear things up. They really leaned into the classifications and providing a bit more rigor around that system. And what they're pushing now is more, stronger evidence behind claims and trying to get better alignment with the broader sustainable finance agenda that they've released. So we always need to think about SFDR in the bigger picture with the EU. It is part of the Sustainable Finance Action Plan that was released all the way back in 2018. And it's part of a kind of broad sweeping package where, different things came out at different times. We had SFDR, we had the taxonomy, we had CSRD, and we know there's been lots of changes in that space. So from the very beginning, the EU is very clear that they were going to keep tweaking and updating these legislations over time. So really, it's just, I guess, a natural evolution. And 5 years in, which kind of went by in the blink of an eye, but hopefully some improvements on the back of it.
So would you say it's a new regulation, or rather an evolution of the existing framework that we've got?
I definitely say it's an evolution. There's the core principles are still there from the original regulation, and anyone who's worked with me on it over with clients know that I talked a lot about it being a disclosure regulation. But they have taken a lot of feedback, particularly about the misuse of Article 8 and Article 9 about labels or kind of systems of greening. And they've tried to bring that in. So I definitely think it's a bit of an evolution. It's not tweaks around the edges. And we're still midpoint, I guess, in that evolution, because as I said at the top, we're not final in the 2.0. So what we talk about as 2.0 would be the level 1 regulation. And that's really the highest level of information. So it sets the overall goals and ambitions and general rules for a regulation. But we should get some more information coming through in level 2 documentation. And if we think back to the original SFDR, the regulatory technical standards, or RTS as people called it, that's where we got lots of details we worked on before. The pre-contract periodic disclosure templates were in there, details about other requirements like reporting frequency, what to put in your website disclosures. That was all in that level 2 that we don't have sight of yet for the new SFDR. So we do have indications, though, in the evolution of the regulation, is that level 2 is not expected to be very detailed or an extensive how-to. So as with the original SFDR, we are going to have grey areas. We're going to have sector-specific nuances and challenges. And I think, as with the first version, the new version, we're going to have to kind of figure it out again as a sector and get comfortable with that grey space and house views, etc. Okay,
so I think you've kind of you picked up on this in your kind of introductory slide about uncertainty, but can you provide any more information on when it's expected to come into force? What sort of timescales have been communicated, if any?
They have been, but I think the EU with the updates to CSRD and the omnibus have not covered themselves in glory, I think, with timelines. So we're very cautious with this. There is uncertainty. So we are moving to a phase now where the level 1 is in a consultation period, and there will be negotiations on it. That was due to close in February this year, but it's stuck open, I guess you can say, because the level 1 has not been translated into every European country's language. And for every day it's over, it gets extended a day. So right now we're on the 24th of March as the closing date, and tomorrow it'll be the 25th, 26th, etc., until this kind of minor point is addressed. Overall, though, the indications are 2.0 is going to come into application and force throughout 2027 and 2028. But this is all very much dependent on, the kind of adaptation period. So summer of 27 and, late on the ground application by the end of 2028. So time to prepare, but not that much time, as we've all been caught off guard before.
But equally, SFDR 1.0, for want of a better word, hasn't gone away, has it? It's not been deleted yet. It's still there. So
No.
if you're launching a new fund between now and when that comes through, you still have to meet the article. You have to decide how to comply, how to participate, whether it's Article 8, Article 6, or Article 9.
Yeah,
Is that
you have
correct?
to comply with the current regulation, which will stay in place until 2.0 is applied. I would say you have to comply with the current one and keep an eye on the new one. So it's kind of a bit of a balancing act for managers out there.
Okay. So what would you, so getting into the nitty-gritty and the detail a bit now, what would you say the key changes that are being, could you summarize the key changes that have been proposed under SFDR 2.0?
Yeah, I think the big one that people will be most interested in this conversation is definitely the replacement of Article 8 and Article 9. So that's where Article 8 we had characteristics, so environmental or social characteristics, and Article 9 we had sustainable investment objectives. We've moved now, as I said in the beginning, to formalized categories. So we have the transition, ESG basics, and sustainable categories, and the ability to combine. We'll talk about those in a kind of little bit more detail. But I also wanted to flag some other kind of changes that might have gone under the radar or been maybe a bit confusing for people as well. Before we talk about, everyone cares about the categories. It's the headline piece that everyone's interested in. But I think it's also worth noting for what we would think of as Article 6 funds or the kind of non-ESG funds. There's a bit more detail and specific rules for those under 2.0. So they've formalized that sustainability claims cannot be central to any of your pre-contract disclosures for those types of funds. And they've even limited it to 10% of the volume occupied in the presentation can only be sustainability and the rest of 90% has to be the fund's investment strategy. So it can be placed front and center if you're staying in a non-ESG fund category.
And just to recap on, just to recap on that, if you're presenting to prospective investors about a new fund and you've chosen not to classify it in a sustainability category, you can still mention sustainability in the presentation. So it clears that up because I've heard confusion there. You could, for example, say we're going to participate in GRESB, but they've gone as far as explicitly saying no more than 10% of the volume of the presentation can be communicated from a sustainability perspective. Have I got that right?
Yeah. And they've gone as far as saying the key investor information document that's released can't be discussed in there at all. And also interesting one, I think, is that any of the claims made for the new fund, they can't constitute claims in the meaning of the categories. So if I think about the categories on transition, that's a big area. We're talking about topics like energy transition, carbon transition. So funds in a non-ESG fund might have to walk a very careful line on those really high priority topics when they have to make sure that their claims can't constitute being confused as a transition fund or ESG basics or sustainable. So bit of tricky navigation there, I think, for some people to try and manage without overstating things. So that's one detail I thought was really important, particularly when we run into the initial onboarding of 2.0, where people might want to hang back, not jump straight into categories. We want to be very careful about how we're approaching sustainability and what we're talking about for those funds.
Okay. So why is the EU moving away from Article 8 or and Article 9? From a practitioner's perspective, we've just got to the sense of understanding. Language has got common around Article 8,
Yeah.
Article 9. You and I will go and meet new clients, and one of the first questions you ask is what's your fund? What classification have you got from an SFDR perspective? Is it Article 8 or Article 9? And that's broadly understood. Why
Yeah.
move? Why change?
I mean, you could say if they want to keep us guessing, I don't know, but it really is like it's part of that evolution. And it all leads back to Article 8 and Article 9 was never intended to be used in the type of language that it has landed in the market, where people talk about light green or dark green or, some sort of measure of how green your fund is.
Yeah.
The market is used them that way. It's a bit of an unintended consequence, but it's one that's informed the evolution of SFDR. So quite often you can write these things down on paper, release them into the market, and then you have to course correct to follow through. But that's, that source has led to a lot of inconsistent application, accusations of greenwashing. So the EU just really wanted to use this opportunity to make a bit more intuitive categories available and try and support investors in their understanding, because remember the end user of all this is the investor, and that can go all the way from your institutional investors who have full ESG teams to kind of smaller scale investors who are maybe more new to this topic. One thing as well I would say is that we were doing, I think, a pretty good job in real estate and infrastructure, but it can't be said, I guess, across the board in the broader financial market. There was it was a bit of a mess out there in Article 8 and Article 9 funds. So,
So what are the alternatives now? So what will be the alternatives when this comes live? What are the classifications? And can you provide a bit more detail on the options available or the proposed options available to funds in future?
yeah. So I think we'll drop away the language, but technically, the transition category is Article 7, ESG basics is Article 8, sustainable is Article 9 in the regulation, but that will move away. We'll just use the categorization language. But if we just think of them very broadly, there's enough details to go on right now from the EU about what they want these categories to achieve. So transition is the one that I think will be most interesting to a lot in real assets. And that's going to be talking about, credible, measurable, Paris-aligned targets. So not to be underestimated in what it's trying to achieve here. We're talking, we need robust data. We're going to need proper procedures. And also, let's not forget, we're going to need action. Which is where a lot of real estate and infrastructure assets are stalling at the moment. And we all know crime assessments, and you got to get your data, measure your baseline, set out targets, plan capex, but the actual delivery and reporting on it over time through the new regulation will heighten the scrutiny.
So just on transition before we go on to other ones, just a thought. So transition goals must also then reflect the age, the life cycle of the fund. So if you've got a fund that is closed-ended, 7-year life cycle, setting a net zero goal by 2040 or 2050 isn't going to work for this category. It's got to be aligned with the fund, has it not?
Yeah, so that
Yeah.
again, this is the thing where all that nuance and details will need to be worked out by industry. So for real estate and for infrastructure, we're talking about real assets, very much, time bound in what you can achieve. So we'll have to work out what we're comfortable with and set those industry standards for what's good enough, basically, for a transition fund. Everyone will have to go through that process. Everyone has a role to play. Us as consultants, industry bodies being active again on providing that guidance for the sector. So it'll take some figuring out. But I think anyone who's made good progress around decarbonisation and net zero over the past kind of 5 years should find some opportunity, I think, in the transition category for the right fund investment strategy as well. Like you said, finding that balance.
So what are the other alternatives then?
The other ones, ESG basics, which I don't love the terminology. It's, it is what it is. It's but it's a category where it's focused on benchmarking and specifically outperforming a reference benchmark. It can be on the entire benchmark or on specific appropriate sustainability indicators. On reading this, the first thing that jumped out to me was potentially things like GRESB, because they're already in place as a benchmark for real estate and infrastructure. It'll be interesting to see what the market does there. And one thing as well, just on the phrasing of ESG basics, it's not the most positive terminology. And also the specific decision to use the phrase ESG might be a bit challenging for those launching funds and raising capital from a US perspective, where there's been a bit more, I guess, of a move away and a bit more backlash to that specific terminology. And it's not like you can call the category something else. It needs to use the language prescribed. So that could be a bit of a tricky element there. Finally, the most familiar one will be the sustainable category. It's pretty close to the previous Article 9 category. We're talking again, Paris-aligned targets, EU taxonomy alignment. They brought in things like EU green bonds and specifically investments in European social entrepreneurship funds. So they provided a bit more guidance there. On the sustainable side as well, they've removed that very confusing different definition of sustainable, the Article 2.17. So that's gone completely, which really muddied the waters in the original version of SFDR. So a bit more clarity here underneath this one. But again, the bar is very high. It's, a sustainable investment category. And one little nuance where you'll see with the EU is they're still trying to tie the line between formalizing these categories and being a disclosure regulation. So they do little things where in the regulation, the order of the categories feature in that way. It's transition, then basics, then sustainable. They won't even rank them in what we would naturally see the order being ESG basics, then transition, then sustainable. So they just try to jumble them up to seem unopinionated about which one is the best. But
okay. So on that, what does this mean for use of the terms green or impact in real estate strategies? We do see this. The industry kind of recognises this, but also understands the risk. So you're keen to get your views on that aspect.
The impact side, there's I guess a good new feature where we can have what's called an impact add-on. And that's only applicable to a sustainable or transition fund. So you can't have an impact add-on for the ESG Basics Fund. Again, EU telling us what they think of that category without telling us what they think of that category. But that one is, I think, a really interesting opportunity. But it is impact in terms of what impact investing means. So it's talking about having objectives around the generation of predefined positive and measurable environmental or social impact. So it's not kind of figuring out, oh, we had an impact over time. It's about setting out what the impact it is, how I would deliver the impact, how I would measure, monitor, and disclose the predefined impact. So you'd have to set it out at the beginning. You couldn't just stumble upon a positive impact and claim it as one. It has to be very intentional, aligned with impact investing guidelines. So good opportunity for anyone who's already ventured into that space to kind of bring that two pieces under one place. So, good news. There's been other good news, I think, as well across the board. One thing that used to be a struggle for Article 8 products was the asset allocation, how much of my fund should promote my characteristics, what's good enough. And we actually do have thresholds this time for the categories, and it's set across the board. So the same for each category. And that's at 70% of the investments must meet the selected requirement of the categories that you're aligning to. So good news in that we have something specific around 70%. maybe bad news for some funds where that possibly could be a challenge for their investment strategy, or maybe something they would be nervous about setting out to. So, particularly maybe debt funds or perhaps very diversified infrastructure funds. But we also have the nice ability to do the combination of categories. So that could be a useful kind of source where you might have some in a transition, some in ESG basics. But
the overall would need to add up to 70% of the by value of the portfolio.
So where we have clarity, we have, I guess, what you could say, a raising of the bar at the same time. So, give and take with the EU on this one.
So just to play that back, if you have a transition label fund going forwards, then 70% by value will have to align to that transition objective.
Yeah.
And then if you have an ESG basics fund and you define your benchmark, 70% by value of the fund will need to meet the benchmark, the basic level. And if you have a sustainable category, 70% by value will have to be sustainable. As defined in the fund paperwork.
One point I think will add some confusion, and I get why they did it. I don't love the intention around it, but is that in the drafting of the criteria for each category, there is an other option for each of them. So they set out specific criteria for transition, for ESG basics, where I've picked up language like, the Paris aligned or using a reference benchmark and outperforming. That's where I got that language. There's also an other approach, which is you can define an other approach which you deem to be appropriate as long as you provide the proper justification. So in doing that, they've added flexibility, but they really have compromised on comparability for each category if a lot of people go down that other route. So it could be interesting.
Interesting. So they've set 70%, but given flexibility in terms of how to get there in the category. Okay. So if we just think a little bit about data challenges, what do you see the main data challenges for real estate managers in complying with SFDR 2.0?
I think on the category side, if we look at some of the language that I've referenced, specifically in the transition and even the sustainability category, we're talking here about energy and carbon. So the common data challenge for our sector. And we can see the direction of travel. There's no coincidence that these topics came up specifically in the categories. So under the categories that we do have the reminder that SFDR is a disclosure regulation. So we're going to need to have the data to show progress over time. So it's also going to need to be available to allow the investment decisions and to really support the transition or support the sustainable investment, and to add that credibility behind it. So could you imagine having, transition fund where, yes, we have our Paris aligned target, but it's not on track against the pathway. We don't have credible data to back it up. We don't really have access to information to carve out, a credible investment plan for what we're going to do over the whole period. And we can't really, in our ongoing periodic disclosures, we can't really substantiate any claims we made in our pre-contract. That's not going to be a nice situation to be in. So it's really going to heighten the need to get access to the kind of core challenge for the industry. Also on the data side, there is a small mention around estimates, so a kind of specific reference to them in the new documentation. Not very restrictive, but it shows that it's on the radar of the EU. So they are saying, no problem with estimates, but they do expect firms at a minimum to have, documented their sources of data for the estimates, their kind of use of external or in-house estimates, and that they should be able to provide to their clients information about this on request. So that's going to have, need to have good governance around your data collection procedures, but also your gap filling on the other side of it.
You can estimate, but you've got to have a record of how you've estimated and what the methodologies that we use to do it
Yeah.
and evidence to back it up.
Mhm.
Okay. Do you think that SFDR 2.0, as it's introduced, will increase compliance costs for real estate managers?
One of the ambitions of 2.0 is to reduce costs, but I think in the initial term, yes, it will increase because, like you said, we were in that period where people were quite comfortable and confident. They knew what they were doing, progressing with new funds. It wasn't as much of a task. So we'll have to go through that period as well around training. People will have to invest, internal and external resources in reviewing and understanding the requirements. And really, if the rollout from the EU is not smooth, it could, cause a burden in the short term where just added confusion, people trying to keep track of this. But it has been estimated, for example, that the removal of the PAI at the entity level is expected to reduce overall disclosure costs by about 25%. So it was a target ambition, but I think in the short term there will be some resources needed. Continuing to manage it over time, if it's set up correctly, which is what we did a lot with our clients of you don't want to tie yourself in knots on a disclosure requirements that lead to big complicated periodic statements that you don't have control over or struggle to deal with every year. So you have to take into account that there will be ongoing disclosure requirements. So if you set it up right at the start, it should run quite smoothly and be aligned with your overall sustainability and investment strategy for the fund. There are some changes expected around the disclosure requirements on pre-contract disclosure templates are going to get a revamp and be, it looks like, capped at 2 pages. So that should shorten down some of that kind of administrative burden on the front end. We know from the current pre-contract disclosure documents, there's a lot of redundant questions in there. And a lot of people can spend some time, figuring those out or drafting them up with legal advisors or external consultants. So those kind of statements will get a facelift and be a bit more streamlined. And I think as well, the thing to watch out for is that, like you said, we will have to continue to comply with the original SFDR whilst ramping up for 2.0. So there could be a period of time where you're doing 2 different sets of reporting, depending on the life cycle of a fund and when it was closed and which version it's operating under. So that could be a short-term inconsistency.
So sorry, Aoife, just on that, would you need to transfer over the all SFDR commitments from one fund to another? When SFDR 2.0 is introduced, is there the obligation to then update the existing paperwork with 2.0 aligned paperwork?
If your existing fund is closed end and it's no longer being distributed after the new rules take effect, you can choose not to apply 2.0. So, if it's fully raised, closed by that date, you can leave that one in the original framework. I would assume you'd still have to do the SFDR original disclosures associated with that, but that would run out with that fund's kind of life cycle. But you don't have to kind of overnight switch everything over. That's why if anyone is, thinking about the next raise, the next fundraise, we know that over the past couple of years, the fundraising period for real estate and infrastructure funds is gotten longer, so 18 to 24 months, and that's going to run right up to the new regulation. So if I was going to go to market for a new fund in the next 2 years, I'd want to be really prepared and brushed up for 2.0. I'd probably launch under the current version, but I would have my Article 8 fund designed specifically as one of the categories.
So that's what real estate managers should effectively be doing now to prepare for funds. I've got one more question, and then we've got a great bunch of Q&As from the audience. So my final question is, What would you say is the biggest misconception about 2.0? What do you hear about in your discussions? What do we at Evora hear about?
I think I've heard and read a lot across LinkedIn and various other areas about it being a simplification. And maybe I'm more of a glass half full type of person. I get it, it is. I know what they're trying to achieve. The categories that we're seeing, the reducing the burden around the PAI, focusing energies on things like transition, and removing some confusing concepts from the original version they're all very welcome. It was well needed, a good update. But 2.0 it's definitely upping the challenge. And the EU are walking the line between a disclosure regulation and a labeling regulation and setting minimum requirements. But the focus around decarbonisation, transition planning, it's really clear in the level 1 document. There's room to do other things, but it's pretty obvious that that's what they're hoping most people are going to do with it. And as with the original SFDR, we have to prepare for those unintended consequences that will ultimately happen, because it's going to be released into the market and it'll be applied and used as everyone sees fit. So I just think things around the phrasing on ESG basics. I think of a lot of institutional European investors that I've worked with and kind of advised clients with. I don't know what their appetite would be for that, language, ESG basics. Could see that they're probably more likely to push for a transition fund, the kind of the groups that I'm thinking of. And with the removal of, for example, the PAI from the entity level, everyone's been on the end of DDQs, investor requests for PAI data at different times of the year. And a lot of time and energy has gone into preparing for all of that, and the reporting around it. So it's great that that will be removed. But we think of these large institutions now, they'll have a lot more time to spend on things that actually matter instead of chasing all the data points for PAI disclosures. And they might, some could drop PAI and say, listen, I'm not required to do it anymore. Drop it and leave it. Others could perhaps start to create bespoke requests and potentially add to the complexity that's already out there in investor DDQs. So that might cause a bit of a split in the market as well, that it would be a challenge to work with. So those are some of the, I guess, the unintended consequences that I have been thinking about already. But still lots of great opportunities that I talked about where we have, the combination of the categories I think will be great for real assets. The transition category alone, just recognizing that to be sustainable from day one is not really possible. Impact add-on will be great, and where there's I think the positives potentially outweigh the negatives at this point.
So with that, I'm going to dive into some of the some of the attendee questions. We've got some great questions, so thanks for that. And jumping around a little bit, but it kind of aligns with what you just said before. We had a question on do we feel that 2.0, the revamped SFDR, will lead to a meaningful move towards outcome-based sustainability assessments? Or are we still largely stuck in this process of rewarding the quality of the disclosure? Will it be the disclosure or will it drive outcome? What are your views on this?
I think it will make inroads to drive outcomes. One piece of news that's kind of come across my desk in the last 2 days is a piece of research that was released and is kind of hitting headlines. It was a study by a couple of parties, so Stanford University, Harvard Business School, and University of Amsterdam and London Business School. And they looked at SFDR and they concluded on their research that the original one didn't prevent greenwashing and it didn't kind of lead to a boost in capital towards sustainable investments and sustainable funds. I think it was a bit harsh to look at SFDR in isolation. As I said, it's part of a larger action plan. And as that all comes together, it's supposed to create the right environment for sustainable investment, to happen. I think the categories where they've left it very broad and open under the original SFDR, I think the categories will sharpen the pencil around action. And really, you should be able to align your SFDR disclosures with any of your decarbonisation goals, and really make consistent and streamlined disclosures and reduce the burden and distraction around it, and hopefully invest more resources in action. Because ultimately, like I said, it'll be great to claim a transition category, for example. It won't be great to do those disclosures year on year when you're not showing progress, and that might really get it up the chain in terms of importance, and having those conversations with fund managers and asset managers, trying to really leverage anything you can to support the overall ambition, which will be quite clearly set out in this new scope. So I think, on a positive side, yes, we all have to maintain some level of positivity around these topics. So we would hope it would drive more action.
That's great. I've got a really good question here on definition of sustainable, and the sustainable funds in particular. When the draft says sustainability, is it talking about the current definition of sustainability, or is it more like the binding criteria? And could sustainability be social or environmental, or is it just environmental?
It's open to both. So on the sustainable
Right.
side, so it can be social or it can be environmental. The definition has been cleaned up a bit, as I mentioned in the first original SFDR. We had that confusing sustainable investment definition under Article 2.17. That's been removed, where it had lots of complicated concepts around do no significant harm and using PAI to show the lack of negative impacts. It was a lot for managers to try and get their head around. So that's all been cleaned up. And again, like I said, with everything in the level 1, there's only so much detail in it right now, and there will be only so much detail released by the EU. If we think about SFDR, it's applying to the entire financial market. So we're never going to get a how-to guide for real estate officially from the EU. It's very unlikely. So we'll have to, like we did with the original, go through the phases of figuring out what is good enough, and trying to adhere as much as we can to the black and white definitions that we have in the regulation. But it is open to both, and it has been cleaned up a bit.
But one thing that might not be open to both is the transition category, because that sounds very energy focused to me. So from a social perspective, I can see how it could work for ESG basics, for sustainability, but perhaps not transition. It might be a simple yes, no on that one. Do you agree on that basis?
It's technically in there, but I'd have a bit more of a, same as you, a bit more of a kind of firm view on it. I think you could go along the line of, on the transition, if you were participating in the concept of a just transition, maybe there could be some uses, but I would say specifically for real estate, I'd probably stick to the core factors of environmental issues on transition, and maybe some different investment strategies could lend themselves to that concept of a just transition.
Equally, there are opportunities to identify classifications and appropriate recognition for funds using social criteria. I think that's important to say. It is not, whilst transition might be heavily focused on from an environmental perspective, there are opportunities to look at the social side of things.
Yeah, it's wide open to both in the drafting.
Do you think there'll be a better better information on international translations for European regulations like EPCs, for example? So I know this has been a problem for funds that launch, for example, in North America, looking at
Yeah.
energy efficiency, and the regulations kind of link back to European Energy Performance of Buildings directives, which reference EPCs.
Yeah.
What are your views there?
So the information that we had on PAI from the original regulation that came to us in level 2. So we're gonna have to wait and see what details we get on PAI in the level 2 on 2.0. One thing that is interesting is that PAI are a requirement for a transition or sustainable category. So it's not kind of where we had the Article 8 funds, you could opt in or out of PAI. If you're going down transition or sustainable categories, you need to use the PAI. What they do say is using the PAI, which are relevant to your fund, and also have left the door open to use other sustainable indicators that could be relevant. So I think that's a site of some of the challenges of applying some of the PAI from the original version kind of de facto, regardless of where you were, and the confusion that caused for non-EU based investments. And we'll just have to see what the details are on PAI, whether they get a facelift or have any changes, or we just get more comfortable as an industry defining the other. And I know on the back of the original PAI, there was a lot of work done through a lot of bodies collaborating to try and pull together standard metrics for real estate. So again, we should all really invest time and support those because it could be very useful, where some of the PAI mightn't fit great.
Okay. And next question, penultimate question, in fact. Will the SFDR changes have an impact on the EET reporting template?
Yes, because it's
Okay.
built for the original. So it's again, that was a voluntary initiative. It's not a formalized piece of guidance or collection template from the EU. So again, if the partners that were involved in the original EET want to change it for the new version, but there will be concepts that will be outdated. But it will stay in place, I would imagine, for a while, as there'll be a lot of funds still operating under the original version for the next couple of years. But they may need to revamp it to capture all this.
Okay. Thank you, Aoife. And last question, which is a really good one, is why would investors into funds, LP investors into funds, be more interested in transition than ESG basics?
For me, on my reading, this is my opinion. I'm not the kind of, the central source on this, but I just find the phrasing to be quite negative. And if you're out there and you're trying to use the categorization, for example, to differentiate yourself in a very tough capital raising market, and you have investors who have net zero targets, they themselves are reporting annually on their progress, and that's going to be out in how they allocate their capital. I'm pretty sure those big investors, institutional guys with those targets, are going to want to, allocate their capital to a transition or a sustainable fund. Basics may have room in terms of certain sector types, or certain investment strategies might not be a natural fit. But I think the kind of the front leading investors on sustainability, I just think from an optics perspective, would be keen on the transition category.
I think one of the key points as well is that point that you've touched on, but just to re-emphasize it, is alignment with their own targets. So a lot of LPs will have their own net zero commitments, their own decarbonisation strategies. And if they can confidently invest in funds that deliver those objectives, then it's a way of aligning all of their strategies together. So I do see a connection there. I think the ESG basics is kind of entry level. It's almost designed to be that kind of, right, we need to do something. So it's entry level, but it'll be interesting to see how that evolves.
Yeah.
And with that, I'm going to issue a little poll now to one I prepared earlier, which is for those of you on the call. which of these, I'm going to launch this now, and which of the terminologies that you've heard Aoife and myself talk about so far today feels more appropriate for your funds, because that feeds perfectly into that last question, and I'll and then we'll just have a look at that.
Neck and neck.
I'm just gonna give it a little. It's neck and neck. I'm gonna end the poll. 3, 2, 1. End poll and share results. It is neck and neck, so it's gonna be interesting. So we've got 42% ESG basics, 35% transition, and 23% sustainable funds. No one has picked up other, quite possibly because we don't know what other means yet, but that's really positive. So I'm going to stop sharing there, and then I've got one more poll question for you, and that's what are your next steps? And this is as attendees, what do you think will be the next steps for this? So we've got review existing funds and develop plans as soon as possible. Wait and see, 100% so far. Review existing funds and investment strategy over the next 12 months and develop plan. The answers are coming through thick and fast, so I'm going to give it a few minutes, few seconds. 3, 2, 1, here we go, and share results. So we can see that this is going to reflect where you are as an organisation, where your funds are, but 13% will again to review existing funds and develop plans as soon as possible. We've got 39% who are reviewing existing funds and looking at investment strategy over the next 12 months, and 48% are saying, look, let's wait and see. There's too much potential variability there. Our advice is, again, it depends on where you are within your journey, within your funds journeys, and what angles and position you have from a fundraising perspective. But my advice would be, as a minimum, is keep your ear to the ground in terms of the changes. EVORA will certainly provide updates on this, and continue to review. And then over time, over an appropriate time, especially as guidance is more formalised, decide, and then review and position your funds and launch. But it's not something that you need to rush into immediately. In fact, you can't rush into immediately. But certainly planning and going ahead, and dependent on your own strategies, that's certainly something that you should be looking at and keeping close. Aoife, any further points on that?
No, but yeah, it's lots of information to digest to get started on early planning, and I think it could come. 27, 28 could come faster than we realise. So yeah, I think getting started as soon as possible is best option.
So we've reached the hour. Thank you everyone for listening and staying on for the call. We will write a note up on this, so we'll produce a short paper based on this discussion and circulate that and get that communicated through our various channels. So I'd like to thank Aoife for answering my questions and going through the questions that you fed. I'd like to thank you as participants who've attended this. Thank you very much. And I'd like to thank the EVORA back office team, for want of a better word, who have helped set this up and organise these things. So thank you very much, everyone, and best wishes in your SFDR 2.0 journey going forwards. Thank you.
Thanks, everyone. Thanks, Paul.